So here we're gonna revisit the three types of money. You've seen this before. If you never have, you can go back to the old videos on the private reserve strategy. But just for a quick review, accumulated money is money that you've been accumulating for future use, right? This is where usually most of the financial advisor, this is where they focus on. They'll say, hey, give me your money, I'll give you a higher rate of return. That's your accumulated money. That's your investments, your 401ks, and all these IRAs and that space. Lifestyle money, this is the money that you're using for your lifestyle on a month-to-month basis. Usually this is where Dave Ramsey focuses on, like sell your kids, live in a tent, put everything to the side, save everything, right? That's your lifestyle. That's usually, like I said, where Dave Ramsey focuses on your lifestyle. Transferred money, this is where we focus on. This is money that you're giving away unknowingly and unnecessarily. Unknowingly meaning if you knew about it, you would stop doing it. And necessarily, these are your interests that you didn't have to pay to the credit card companies. These are your taxes that you didn't have to pay for the government. That's your transferred money. But today, since we're talking about mortgage, um, that's a big decision. And there's going to be a lot of transfers that's going to happen when you decide to buy a house or purchase an investment property, right? This is money that you might be giving unknowingly and unnecessarily. So if you want to pay your house off faster, we should do it in a way to where you're going to pay the least amount of money as possible. You're going to transfer the least amount of money as possible. So the goal here is to help you get what you want without changing your lifestyle. So we're going to talk about this transferred money part. And these are the areas, again, I've explained this before in the other videos, but since we're going to focus on mortgages, these are the areas that you have most of your wealth transfers. But since we're going to focus about mortgages, so we're going to go here. So when you buy a house, you're actually buying two houses, one for you and one for the banks. If you're not careful, then you're going to start the construction on your construction for the federal government, right? Because if you, again, this really just depends on if you qualify for mortgage interest deduction. If you don't, then again, if you pay cash for it, you might be constructing this part right here to the federal government. That you still get to pay taxes, you still get you still have obligations, whether you pay for it in cash or when you finance the house, right? So, like I said, when you buy a house, you're actually buying two houses, one for you, one for the bank. If you're not careful, you're going to be paying to the federal government more than you have to. So let's explore that a bit. When you finance a house, let's say you're buying, how much are houses nowadays? That's usually 250 to 350. That's your entry level here in Texas, right? So let's look at 300,000, right? That might be a better number. 300,000, 6% interest rate, 30-year term. That's your 30-year mortgage at 6%, which is where we are right now, 2023. You actually paid an extra $347,000. So meaning you paid your 300 plus an extra 347,000 in interest to the bank. So that's when we talk about two houses that you really bought, right, with the bank. But what most people don't see is if you could have put that 300,000 somewhere where it's going to earn 6%. That's what we're going to calculate the opportunity cost here whenever you're buying a house. What that 300,000 could have earned for you is $1.8 million. So this is what most people don't see. This is why owning a house is actually very expensive, because you're not just if you're paying cash for it and you could have put your money somewhere for 30 years at 6%, that house would have cost you $1.8 million. Okay, so I want you to understand that there's different layers to this. This is your price of the house. This is how much you're paying in interest to the banks, and this is what most people see. What most people don't see is this, is the opportunity cost, what that money could have earned for you if that account, and I'm just calculating it at 6% in 30 years, that was a wealth transfer of $1.8 million.